There's so much going on in the world of multifamily investing that you really need to start paying attention to. Today on the Gray Report, we're going to get into several different reports and articles. One from MSCI, really kind of breaking down where we are in this movement of interest rates, inflation. Another piece from Cushman & Wakefield, really kind of digging into where we are and the economy and how that relates to commercial real estate. And then a word from John Chang from Marcus & Millichap on focusing on distress, which we talked about last week, but distress in the multifamily market and commercial real estate, and really posing the question, are we really through most of that distress, or do we have a little bit more that is right in front of us? And then really onto demographics, looking at household sizes, household formation, with pieces from RealPage and Carl Whitaker, looking at the average household size is actually ticking down. But then from apartment lists on a piece is showing that more young adults are living at home with their parents, more so than the 1940s. It's incredible. Kind of counterpoints. And then from the Harvard Joint Center for Housing Studies, again, looking back at immigration, how immigration is affecting household formation, the heads of households, and how that might affect the housing market for years to come. So strap in if you are an active investor, passive investor. You're going to watch every single minute of the Gray Report. Make sure you subscribe to the Gray Capital YouTube channel. I'm joined by Dr. Matt Bosnagle, Director of Communications and Marketing here at Gray Capital. We're going to have a great episode. Let's get into it. Welcome back to the report.
Hello,
Matt. How's it going?
it's good to be here. It's been a kind of a happy little week.
That's good.
There's lots of good news that I've been getting. GDP was surprisingly up. Now
Yep.
it's probably be revised down, but there has been some murmuring that maybe next month we'll get an interest rate cut. There's also news about maybe slightly improving consumer sentiment. Pretty great news. Only thing is, I'm still worried about employment. It's been trending down. Like the growth has been trending down. The unemployment's been ticking up slightly, but still within manageable levels. I just don't want to be caught flat-footed and be like, oh yeah, you didn't say anything about employment. Well, that was the canary. But I think that there are signs that with inflation down so much, and I don't know. Maybe we could see some light at the end of this tunnel. That's what I'm hoping, and I'm not the only one hoping this.
Well, I think that people are starting to call out some light at the end of the tunnel. I think that again, there's the storm clouds that are on the horizon, and it's tough because again, it's good news for people who love bad news. A slowing economy is what we've been wanting to see, and higher interest rates, the idea that those are finally working their way through the system, slowing things down a little bit. But obviously, we don't want to overdo it. The Fed can't overdo it, and it's threading this needle to achieve that soft landing. Again, most planes don't crash mid-flight. It's on takeoff and landing, and so that soft landing appears to be achievable, but at the same time, it could easily overcorrect, and if growth slows down too much, we could see or find ourselves in a recession.
Yeah.
But there's really not a lot of evidence pointing to that directly right now, other than just like, well, the direction, the glide path is slower growth.
I was trying to chase down some other information that we talked about in a previous Gray Report episode. It was actually about the percentage of investor-owned single-family homes.
Oh,
which
yeah?
I'm going to link to this short that I made last night. I spent a lot of time doing that. But anyways, well, the upshot to that is that there's actually a very small portion of single-family homes are owned by large corporations, like 2.6%.
That's not what the
like.
media has told me, Matt.
Yeah, well,
and that's not what social media has said either.
I know.
So.
I did this thing last night. I took the line graph and I shrunk it down and made a little animation of this is how much you think it is. This is how much it really is.
We're going to have to follow the Gray Capital social media channels.
It's a great video. I'm going to try to overlay that. I'm going to get the editor to overlay the little animation there.
Sweet.
So.
Good stuff.
Anyways, the what I did notice when I was going through this is like a lot of chatter about interest rates from 2022. Really, oh, it's never going to end, or oh, it's right around the corner. And it was what was interesting is that it never really changed. There was never really a building consensus, except for right now. So right now it does seem like all this expectation for a rate cut. Is there anything different than all the expecting that we were doing in mid 2022?
I know nothing that anyone else doesn't know, other than that sentiment on rate cuts or higher for longer has shifted back and forth. I've been calling, again, not necessarily a scientific call, but even that we could see that first rate cut, be early 2025. Now the consensus is that it's going to be in September. The Federal Reserve is going to reduce the Fed funds rate, to most likely by 25 basis points. Some folks have thrown out 50 basis points, but there's concerns if you do too much, does that throw some sort of negative signal to the market, or is that exactly what the market needs? Because maybe if you just do 25 basis points, everybody gets excited about that.
Well, look, there's some data on in this Cushman and Wakefield article on just that. There's a chart on how many people are projecting a cut and how many cuts do they think are happening. So I think it's it's definitely an interesting data point. I think it's different. I think that we have gone through actually, from really the bulk of 2023 and especially at the beginning of this year, people weren't really thinking that there'd be a cut. There was a period in this year especially where it was like, no, we're not going to see this until next year.
The 10-year was, at the beginning of the year, the 10-year was below 4%, and then all of a sudden, we touched 5%, and then we came down, and then we got close again, not all the way to 5%, but and just going to this is the chart of the 10-year, but also if we look at Chatham, this is SOFR forward curve. We look at the 10-year Treasury. That's the forward curve. Basically, there's still anticipation of it increasing potentially. Let's go back to this Fred chart of where we are.
Yeah.
But we brushed 5%. We came down, and at this point, people were like, "Okay, it's going to go to 5 or 6." There's no end in sight. Then, as we were at this point, back in now this is December 23, beginning of the year. We were all the way down below 4. Everyone's like, "Okay, we're good. The Fed's going to start cutting." But inflation hadn't really gone away. Housing data is so delayed, which we're going to talk about a little bit more also. And we got all the way up to, 4.65. And everyone's like, might as well, we're going to go to 5 again. But since then, we've been on a very consistent trend lower. As, growth data has simmered, inflation data is cooled down. And just expectations are for slightly lower growth, slightly lower inflation.
And that's a good point. It's not just like that the narrative is shifting or that like the language from the Fed, although the language from the Fed is shifting if you want to parse words.
Do you think that they're going to wait? There's been some speculation that they'll wait for the speech in Jackson Hole, I believe in August, which is, if you remember, that's when they basically announced that they would be, keeping interest rates high. And that they were going to, remember that like dark Jackson Hole speech of 2 years ago? And to kind of round it off, that they will have a Jackson Hole speech, essentially discussing that the kind of the path to normalize interest rates. Because you really have to think about it, not that necessarily in terms of, the interest rate is being lowered. If as inflation recedes, that real rate of interest is actually increasing because the growth is lower, but you're keeping the cost of money higher. So it's actually more restrictive. The less inflation, keeping the rates the same, the more restrictive monetary policy is on the economy. And so it's not necessarily that we're easing and all is good, because again, 25 basis points isn't going to save anybody's deal. They need to refinance. But it's really realigning to saying we're still going to have a relative restrictive policy, but we don't need to be more restrictive than we have been because we're seeing the economy slow down. And I think if it's framed in that context, and we're going to be on a measured step, still be data dependent, et cetera, et cetera. I think the framework could be laid out at Jackson Hole.
I think that they've been clearing the way for that kind of argument for a long time, especially in their recent remarks and in recent meetings, and whenever they have public remarks. I don't know. It seems like they're called before Congress every other week, but they give hints, and that's what we have said this before is part of the role of the Fed is to communicate what they're doing so that things aren't a huge surprise. So I think that the Jackson Hole speech, I do think that they will mark a shift. I don't think it's going to be a whole huge dramatic shift, but they'll say, we're changing things, and I believe that would be a really good opportunity because we are at a moment where it's appropriate. It wouldn't be like they're announcing this and the timing's a little off. We're announcing it now, but we're really not going to get started till next March. I think that, again, I mentioned stuff about the narrative, but that's one thing. It's the numbers that are changing that are really driving the narrative, which is inflation and employment. And GDP is a little bit of an outlier. We're seeing that there's more growth relative to the lower employment and lower inflation. So that's interesting. But I think that all of these things are building in a way that they have not built before. So the difference between late 2023, when there was a lower 10-year and there was maybe more optimism about a potential rate cut, we hadn't seen great progress in inflation like we have now. We're seeing much more lower inflation and the trend of lower inflation, even negative inflation last month.
Yeah, true.
And that was not happening in 2023, at least not to the degree it is now. And again, it's also a consistent trend. So again, employment has been consistently kind of getting weaker still, historically great, and inflation for the past several years. This is a trend that's building. It gives credence to the stories and to the expectations of people that the debt situation is going to improve.
Yeah.
And thank goodness, because I keep pent up is the theme for me when I was reading all of this. There's a lot of pent up housing demand. There's a lot of I think there's a lot of pent up consumer demand in general that is ready to be unleashed, but can't be because there is this affordability barrier, and especially in the housing market, this affordability barrier, big chunk of it's got to be loans.
But also it's on housing, but it's also credit card payment. It's new car loans. It's anything that's financed, which there's a lot that's being financed today in society. But then it's all the other inflationary pressures. Man, I just pulled up August 23rd to 24th, Jackson Hole. The theme of the symposium, that's what's called the Jackson Hole Economic Policy Symposium, hosted by the Kansas City Fed. The topic is reassessing the effectiveness and transmission of monetary policy.
Yeah, that's probably already written, right? I mean, they have that slideshow already done. They're just changing the fonts, maybe, but they've got that written. Maybe they wrote it a month ago.
Or that's what they're just. Most likely, that's what they were discussing yesterday and today.
Yeah, exactly.
As the Fed FOMC meeting gets together.
Yeah.
Because I think that they were probably. They probably have two speeches ready to go.
Yeah.
Staying the course and all right, now we're going through a shift as we reassess. And when they made the title reassessing,
that's a good out.
They did that before they knew what they were going to do.
Yeah, we're going to reassess, and we found out that we don't need to change it.
Exactly. All right, Matt, anything else on this Cushman and Wakefield piece?
No, only that they note the decidedly dovish shift from the Fed in one of their headings, and they also say don't overlook the upside surprises in CRE demand this quarter, and noting that too little attention has been given to the robust demand formation for apartments. Well, not from the Gray Report. U.S. multifamily vacancies declined by 10 basis points in the second quarter as absorptions tops 138,000 units. This ticking down of vacancies is significant, and that's another thing worth following. We've heard a lot. We talked a lot last week and really the weeks before about the pressures of the apartment market, and there is a suggestion here, and I said this before we started recording today. There are some apartment operators that may get out of it. There's some apartment that would have been distressed if not for the relief that's coming.
It's interesting you say that, man. I was thinking about that this morning, and excuse me, it comes back to the idea of extend and pretend, and we're kind of getting to a period of where we've been hearing that a lot of lenders are kind of over the extending, but may they be more willing to extend if there's less pretending that they have to do and there's actually a path. And so if the Federal Reserve, whether it's at Jackson Hole announcing the framework or the actual announcement in September or whenever that announcement is, again, if you've got a good borrower with a property that's doing okay, and that borrower, which a lot of borrowers are doing, is funding that debt service payment out of their own balance sheet, so they're putting money into the deal. The mortgage is getting paid. Maybe the debt service coverage ratio of the property is, in the kind of the distress level. But again, the mortgage is getting paid, or the lenders, again, looking at it and saying there's a good chance you're going to be able to get out of this. The likelihood of that has increased. It's not certain. It's not certainty, but it's much clearer than it was several months ago. When the 10-year Treasury was back at 4.6%, and people were wondering whether we had some of those hotter inflation prints earlier in the year. There was a much more question at that point. It's almost like the lenders, may be more willing at this point.
Yeah,
but it's been a long time. It's a lot of extending. It's a lot of pretending.
And I think like probably this will avoid like overdue tragedy. Like, they will. I keep thinking like, well, if it reaches the breaking point, then the Fed's probably going to think we failed. They don't want anything to break. I think that giving a path for future rate cuts, like, oh, you're a troubled borrower, everything's going okay, but we don't want to, we don't want to blow this whole thing up. Oh, now there's a path to lower interest rates. Fine, good. We didn't want to break your heart. On the other hand, I don't think that even a quarter point or positive indications, if there's a really bad operator out there that really made bad decisions, I don't think that the banks are going to give him a chance, because they got a whole year plus of elevated interest rates anyways. So they're going to say, listen, you didn't perform, we're done extending. 0.25% is not going to change things dramatically, so we're going to have to cut you loose. So in the same way that it'll avoid some pain from a lot of people, some pain's going to still stay there, because things can't move fast enough for them to get out from under whatever they're buried in.
So just on the same topic, Matt, as this piece from MSCI, and some of the key findings are basically what we've been saying. High borrowing costs have been a pain point for real estate investors. There's hopes that relief would arrive in the form of rate cuts by the Federal Reserve. So far, it's been thwarted by sticky inflation. That's kind of been previous, earlier this year. But then, as anticipated rate cuts have moved further out, investment sentiment in commercial real estate has softened, which I found interesting because from a lot of the capital sources we're talking about, there's actually some renewed investor interest. But as I dug into kind of the source of a lot of this information, at least on the sentiment side, they're really pointing at the Pension Real Estate Association, the PREA, and it's really focused on not just multifamily, but commercial real estate as a whole. And so when you're talking about commercial real estate, specifically the type of stuff that pensions and insurance companies invest in.
Careful people.
Yeah, I mean, they're careful people, but they also invested in a lot of office space.
Oh, okay.
Not that they invested in across all the food groups of commercial real estate, but definitely we're investing in a lot of office properties. And so when you talk about and you ask the question of what do you think about commercial real estate, to these inherently operating a pension fund, they're very conservative. And
that's what
super opportunistic. And this is the group that would want to see the all clear. We talked about in the last episode of waiting for that all clear. And if you wait for the all clear, there's certainly an amount of safety in that. Of like, look, the market is set, it's stable, we're going forward. It's not a bad decision, but you're definitely going to give up quite a bit of returns because you're going to miss out on the best deals. And you're going to be into the market a little bit late. I just did a video, Matt, a couple of days ago that we're going to be posting that kind of gets into that, of really focusing on, should you, wait to buy the rumor, sell the news, or you're going to wait till the news is out and then make a decision. You can do that. Again, risk equals return. You're going to take less risk, but you're going to get much lower return. That's how we try to just parse the data and actually get the information just to stay ahead of the curve. And so, this is looking at some of their forecast total returns, and they don't have great forecasted total returns really until end of 25 and 26, which that precisely overlays with the timeline that we've discussed on previous episodes, Matt. It's going to be in the 25, early 2026. But by the time that kind of recovery is taking place, the prices and the values of the asset are all going to be bid up, and it's going to be priced in. So you have to get the basis today in order to get the growth tomorrow.
That's why it's called basis. That's good.
Exactly.
You got to start at the right point. That's really interesting.
And I think this is a really good piece because I think it lays out a good story of kind of where we've been and where we are and where we might be going.
And just those lines right there, you could overlay that with interest rate expectations as well. But like, they thought it would be good, they thought it would be great, and then it didn't. And
look
at this. There we go.
The realized Fed funds rate versus the 36 months forward-looking curves. So this shows the forward curve. So this is what investors are betting and believing that the future of the Fed funds rate will be. So going forward, and basically the slope of the rate going forward, and every single time at pretty much every moment, those investors have thought that rates would come down much sooner, starting all the way back in 2020. I mean, the forward curve said that the Fed funds rate would basically top out below 3% and then decline from there. And then all along the way is predicted a short-term
Oh, it can't get higher than 2. Oh, it can't get higher than 3.
Exactly.
Oh, yeah.
It's been wrong every single time. And so, the current forward curve, at least, I'm not sure the exact date of when they took this data. We've got another forward curve that we can look on the Chatham site right here. The 10-year Treasury looks like this is SOFR, but come on. The forward curve here is that basically by, July of, really any moment now, September, essentially, the rate is going to start dropping by August. Basically, where's the first 25 basis point dip? September, they've got SOFR at 515. It's basically dropping by about 10 basis points a month. And then in December, drops all the way. That's where the big shift goes from November down to December, 25 basis points, 471. Again, it's been wrong every time. But they basically by, let's call it, October 25, end of 2025, that SOFR rate's going to be down, according to the forward curve, that has always been wrong, it down at 3.83%, which would provide an incredible amount of relief in not the too distant future, Matt.
Yeah.
This is not that far away. We're talking half of a year.
Yeah.
Less, we're talking a little bit, basically 6-7 months.
This Cushman and Wakefield thing, I think they said that some of their respondents expected 2 rate cuts by the end of this year, by the end of the year.
Yeah.
That's pretty dramatic. And it is worth noting that I think we're going to get a whole lot of excitement after the first rate cut, because there'll be this expectation of a huge, larger trend. Otherwise, and then the following ones may not have that baked in. But once this initial cut, and that's probably what is making the Fed so careful, is they don't want that overreaction. But in some ways, it's going to be an earned overreaction because it's a pathway. I don't know if.
Do they need to see what the reaction is before they can really chart out the full course? They're like, hey, let's do the first cut.
Probably.
Let's see how
That's
the
a good
market
point.
reacts.
Yeah.
And then if it's like markets kind of absorbed it well and we're still seeing we didn't spur new growth in inflation. It definitely will. It definitely will. The market's going to pop a little bit, but it's how much.
Yeah.
But more importantly, do you see any impact in inflation and CPI data because of that?
Yeah.
And if things start heating up, and seasonally that should not, but seasonally should be very effective, which would be another reason why they would do it in September, going into the slower months, November, December, January.
Yeah,
it's not a bad idea, just because they've got that seasonality cover almost.
Yeah.
But if all of a sudden inflation does start peaking up, you might say, hey, we're going to just hold it here. And then if they skip a month, I think that would show some discipline. But on the other side, if they see continued slowdown in growth and in inflation, and even some worrying slowdowns, they may even accelerate and say, like, there's no cause for alarm, but we need to move a little bit more aggressively. Maybe we'll do a 50 basis points drop instead of 25. Yeah,
the last few months have been interesting in that, like, aside from, again, like the employment trends, all of the trends have been positive. There hasn't been anything like, oh, I'm getting a little bit scared. And that's why
anecdotes here and there, but everything that.
And what we were saying for so long last year is like, well, there hasn't been enough pain yet. We've been talking about like the pain that people were feeling or not feeling yet. And I think that there may not be pain, but there's numbers on the side of on the side of like lower inflation and I don't know, I don't want to say soft landing, but it could be as soft as reasonably possible. I just
soft enough landing.
Yeah. I think there's good reasons to be optimistic here, and even if people do get excited, I think it'd be well worth it. And it's good to get ahead of it.
It's been a long road.
Yeah.
Let's just listen in. John Chang from Marcus & Millichap put out a piece. We're not going to watch the full video, just a little piece. But John, friend of the Great Report, we puts out great stuff. What do you have to say?
With the Fed beginning to signal an increased likelihood of a rate cut in September, and with inflation showing a clear downward trend towards the Fed's target, it looks like we're on the backside of the high inflation, high interest rate cycle. We're not through it yet. There are still some headwinds and some choppy water ahead for us, but it does look like we're through the worst of it and the market is beginning to turn. So, as you're perusing headlines, remember to take them with a grain of salt. Don't take them at face value. Dig under the surface with a shovel, not a rake. And at the end of the day, don't get too caught up in the media. Take a moment to look forward. Ask yourself what the market will look like at the end of your hold period. What things will look like in 5 or 7 years. Because at the end of the day, real estate is a long-term investment, and you need to keep your eyes on the horizon.
I think some sage advice from John Chang.
Yeah.
Marcus and Millichap.
I think ultimately that so the question was, will real estate distress surge? And the answer was fairly emphatically no. It's not going to surge. And in that video, he also talked about, there are numbers of like multifamily distress up from 2.6% in January to 7.4% in June. But John Chang does qualify that and says that data source's definition of distress includes a big chunk of performing and non-performing mature debt, basically loans that have come due, and it also includes loans in special servicing that are actually current, but lenders are actually, though, like we said last week, kind of getting a little more strict. They're starting to phase out their special servicing. And it's also worth noting, and he notes too, is that just because a property is in distress doesn't mean that like the fire sale's coming. They're not. There are people that could maybe just hang on and still be distressed, but they'll hang on maybe with a rate cut.
The one piece, we haven't brought this up, I think, and I don't necessarily think that's going to be a major market move downward, but an increase of volume as interest rates, come down, more buyers can come into the market. I think what we could see, prevent cap rates from compressing too quickly, although I think that cap rates have already seen to start compress some, is that developers are looking for an exit.
Yeah.
A lot of developers who have deals that they're floating, funding their own balance sheet, and they're waiting for the market to recover to a point of where it's a little bit more palatable to them.
Yeah, pent up.
It's a lot of pent up. So that's going to be a lot of refinancing, holding for a longer term, try to get another bite at the apple, try it again, see if you can operate it and lease it up and get a better price a couple of years down the road.
Yep.
A lot of these deals are just going to go to market to try to get break even, maybe a little bit of below break even, just to get that capital back and redeploy it.
Yeah.
Do new projects. So again, I see that as us working through kind of probably the first half of 2025, especially if rates are lower. I think it'll unlock a lot of those deals. They'll be done, I think, at just discounted prices from the peak. But I think we're going to see those prices. I think there's going to be a lot of competition because there's a lot of really attractive deals that are going to be coming to market, and there's a lot of investors on the sidelines ready to pour in.
Yeah. And when it comes to distress, we have commonly noted that like it's not going to lead to a breakdown in the entire multifamily market. I said this just 2 minutes ago, right? Like there's nothing that's going to be broken. And I did say last week, I said that I commented I hadn't noticed any headlines calling for the apocalypse. And then later that day, I read a Globe Street article that had the headline, "Multifamily Distress Could Head for Real Estate Armageddon." Subscribers to the Gray Report will know that I immediately put that on the newsletter, and that was like one of the most clicked articles that week. So,
tell me the difference between the apocalypse and Armageddon.
I looked it up. Armageddon's the place. Apocalypse is the battle. Armageddon's more of like a biblical reference to the place where where apocalypse may happen. But yeah, I definitely.
In the cult classic 1997 release of the film Armageddon, Armageddon would be on the asteroid.
Yes, I'll go guess. Okay. Yes, that's what I would argue for
I'm
sure.
glad we cleared that up.
To summarize, though, that article itself actually, so it said real estate distress could head for real estate Armageddon. Could is doing a lot of work in that headline, and it was just what we're saying, right? People are looking for opportunities. It wasn't saying the multifamily market is going to completely be turned on its head. It was like, here's an area that we are poised to snap up opportunities. I think that there's like a lot of these opportunistic investors that are waiting to pounce on like the wounded antelope at the back of the pack. Yeah. That wounded antelope may not be so wounded. It may go and join the pack again.
Yeah, you got to be ready. Might have a little life in it.
Yeah. So,
back.
And I agree.
I think a lot of the sellers are like that. I think the people are assuming that we've got a lot of distress, and I think they're more stressed, but they're not necessarily ready to just give away the farm.
Yeah, and I think that's what John Chang's noting too, is like, don't expect huge drama. That being said, that jump from 2.6% to 7.4% in from January to June in multifamily distress, that's a meaningful jump. And
is it surprising though, given what we know about the market?
It's not surprising, and I think in this low sales environment, there is an opportunity. It's an outside chance, but it's not impossible for that extra 4 or so percent to like move the markets. Like that could have a measurable influence if all those end up in fire sales. But still, small percentages can move the markets in strange situations like this when there's low sales activity.
Yeah, but at the same time, the Blackstone deal of AR Apartment REIT that closed, I think late last week.
Oh, really?
So there's also market activity going the opposite direction. They're supporting, suppressing, or compressing of cap rates, which is fascinating. Matt, let's move on to these demographic pieces. They're all kind of similarly related. Where would you like to start with the apartment list piece?
Let's just start with apartment list.
So Chris Salviati, friend of the show, put out a really good article, really just yesterday, a couple days ago, titled "More Young Adults Now Live with Their Parents Than at Any Point Since 1940." This was interesting because, I think that there's some anecdotal explanations to this, and then there's still a part of it that's a little bit head scratching.
Yep.
But, basically, Matt, we've got more folks, more share of, in this case, 25 to 35-year-olds who would be prime apartment renters living with their parents, really since the 1940s. Immediately two things come to mind, Matt. One is the great financial crisis, and the second being COVID. As we both know, the great financial crisis, really took the wind out of the sails of an entire generation.
Yep.
You and I are in that generation. We remember how difficult it was. I mean, there were no jobs, kind of post great financial crisis for a couple of years. Our earning power was greatly reduced, and we kind of lost a good 5 years. I mean, some people figured it out sooner than others, but a lot of folks, they moved back in with their parents and didn't move out, or kind of stayed for a much longer period of time, or that became a little bit more acceptable because you just had to figure it out. And housing costs had also been rising during that period of time. And then COVID, a lot of people, it's like, can't go anywhere. Might as well move back with mom and dad if you've got a room, and why have your apartment if you're working from home anyway? Some people obviously want their own space. I'm the type of person that's like, I want my own space.
Yep.
Some people are like, no, I like hanging out with my mom and dad. It's cool. Some people's parents are getting older also, and they're like, I want to move in just to help take care of them. And that's just a natural part of life.
Yeah, that's a good point.
Also, but tell us more. So it was an interesting.
No, what you noted about the great financial crisis was, I think that's the most dramatic moment. Was when people started moving in with their parents or unable to kind of move out. But you see this graph here. Every subsequent generation has lived with their parents for slightly longer than the previous one, starting with the silent generation on in. There's no real intersection or improvement. They talk about a U-shaped curve where there was a point where a lot less people, but if you track at any one moment, at any age, the previous generation was living with their parents less than
and Gen Z starting from a higher
generation.
point than any other generation had started also.
So in a sense, yes, it's great financial crisis, but no, we're talking about a multi-generational trend of living at home a little more. And the trend isn't huge. It's like what we're talking movement.
Well, the great financial crisis was 14 years ago?
Yeah. So
decade and a half.
So that's not a long period of time. But it's interesting. This is the one that
the
was
affordability.
Very revealing to me, and it's crazy how unaffordable what this says about unaffordability. Fewer adults who live with their parents can afford to move out. These are what we're looking at here is the share of 25 to 35-year-olds living with parents who can afford median rent in their county. In 1960, it was 60%. Now it is at 18%. 18% in 2022, that is. Now that may be a little bit better if because rents have improved from the renter's perspective,
and also the median rent is not just for like a 1-bedroom; it's for a 2-bedroom. We're talking about one person, so they could be living with roommates. But still, if we're looking at the same type of data, there's a lot of reasons for this. We haven't built enough housing. I mean, the purchasing power of Americans has been decreased, because the Federal Reserve has printed money and we've had inflation and the rest, and it hasn't kept up Wages have not kept up with inflation over time, and I think there's probably a little bit of correlation from the difference between the 1970s. Saw a big drop in 1980 with Bretton Woods going completely off. The gold it's completely separating the United States dollar from the gold standard and really allow fractional reserve banking to kick into a high gear.
Yep.
Again, destroying the purchasing power of Americans. And I think
that was a bigger jump from 70 to 80 than there was from 2000 to 2010. Man. 12 to
There's a lot of
13,
jumps, post Bretton Woods.
Yeah.
And then when Nixon completely divorced the dollar from gold. And that's also, again, we're going off topic here, but I mean, it's allowed the federal government to spend a lot more money, print more money, again, because it was completely decoupled from gold. There was no tether.
Yeah, that I think so.
And it's interesting. Countries around the world are now loading up on gold right now, Matt.
Oh, really interesting. Well, and some of them are noted in some of these articles that we just discussed on the federal funds rate. There are other countries that are cutting rates, so get with the times.
And we should have included that in the conversation of rate cuts. Is that the ECB, Canada, UK, all have cut rates. But it's also all a good reason to buy real assets, gold, multifamily. Great thing about multifamily is it pays you cash.
Yeah. Well, and so this affordability thing.
Anyway,
really, to return, and it's all part of this affordability angle. And things are getting less affordable. Things are getting pent up. Again, these are people that can't afford. They want to, but they can't. And the barrier is what they say here is affordability. I was thinking, is this a roommate versus a parents thing? Because I'm trying to square this with some other data that we're going to discuss.
This is specifically with parents, not roommates.
Yeah.
Do we want to switch over to the real page, the Carl Whitaker?
Yeah,
post?
let's talk about the Carl Whitaker
just because
because
it's such a good. It's just an interesting counterfactual to this data, and it's not talking about the same exact thing, but it is. You would draw different conclusions if you looked at the data in isolation.
Yeah.
So according to RealPage, and this is from RealPage Data Science, Carl Whitaker, friend of the Gray Report, posted this on his LinkedIn 2 days ago. It's showing the average number of residents per household on new lease agreements. So you'd think in an economy that was struggling with affordability, people would move in together. You'd have more roommates rather than getting your own space. Now we've gone through COVID. People like their own space, but your budget's your budget. According to this data, we've actually seen a decline, kind of starting mid 2022, to a decrease again of average number of residents per household on new leases. So we're seeing less roommates. Now this has nothing to do with living with parents. These are for the folks who've decided I'm not living with my parents. I'm going to go out.
Yep.
So in a way, the logic tracks of seeking some sort of independence. If I want roommates, heck, I'll just go hang out with my parents because, my mom will, maybe clean up after me and then maybe she's going to make dinner.
Yeah.
Whereas my parent or my friends are going to get mad at me for, not cleaning up the dishes.
Yeah.
I don't know if there's that dynamic or what.
Or you want to get away from your parents and forge your own thing.
Well, that's a thing.
Yeah.
So it's like if you want to get away from your parents, you are also looking for that little extra bit of independence, and that same independent streak might cause you to not have roommates because you're sick of dealing with roommates.
Yeah.
For after a while. Without have roommates.
I mean, man, what is it? That 18% number can afford from the earlier article.
Well, but that's and exactly. So again, looking at that piece of just affordability. It's surprising because not that only 20%, 18% of folks 25 to 30 can afford median rent in their county.
Yeah, it's and Chris Helvey really wrote a very good article here in this apartment list post.
Was there a larger? Do you know if this is a part of a larger report from RealPage, or
no? This is
are they just
the RealPage?
Are they pulling it out of like an upcoming data piece?
Carl Whitaker at the end, it's like, thanks team for helping me get this data together. So it was like, it's cool. I like what a buzz of intellectual activity at the RealPage.
Maybe we can have a debate. Because we've had both Chris Salviati and Carl Whitaker on the Gray Report. Maybe we can have them both come on and again,
how to square it.
Yeah, exactly. Because it's not like they are looking at they're posing the same question and they're coming to different conclusions, or the data is showing different things. They're parallel questions. And how do we square all of it? Really related to household kind of formation.
Yeah. And I actually did have some household formation data that I was looking at, and household formation has stayed relatively stable throughout basically since 2022, maybe like third quarter 2021, it's hovered between 1% and 2%. The interesting thing, and that's year over year growth. The interesting thing about household formation is there is usually in post great financial crisis, there was like 18 months of it being elevated, and then it drops down, and then there are these bumps of like where it plateaus for a little bit, and then it goes back down to like 1 or 1.2. What we haven't seen after 2022, so it's been a few years where we're like due. It feels like, just looking at the chart, that we're due for a bump in household formation. And I did overlay it with the federal funds rate, just for fun, like the year-over-year growth in household formation. How does it work with the federal funds rate? And it wasn't that like a clear-cut thing, but it certainly looks like high interest rates are preventing household formation. It is the key. It's a very important affordability barrier. Maybe not so much for renters, but definitely for home buyers. And I would argue too for renters, because of, it would make it easier to create more housing there. But it would just, I think it's interesting to think about how these two things interact, and how much, I think the key difference between what Carl Riddiker's data is and apartment lists is, we're talking about the apartment list data with people living with their parents, that may be like a generation of these long-term data, these longer-term trends. And the real page data is 4 or 5 years. We're looking at maybe quicker reactions. And I do think that there's an explanation. I can almost understand Carl Whittaker's data more than the longer terms. I can't wrap my head around that. Yeah. But Carl Whittaker's is, I think it's key. Like, things are starting to turn around. Cushman & Wakefield noticed vacancies are down. Things are starting to get
well, and some people are making more money, but in wages outside of the last several decades, the last 2 years, year and a half, wages have outpaced inflation and rent growth.
And that's what Carl Whittaker said very much. He cites wage growth as that driving force between the shrinking household size.
And is it almost like a different subset of, like, kind of like the haves and have-nots? It's like some people, their wages are growing, they're getting their own apartment, and other people, they're just moving back in with their parents.
Yeah, that could be really true. And that was in part of the articles that I ran across when I was getting there. It is a haves and have-nots of inflation, haves and have-nots of the housing market. And there are a lot of things that I think could be, that so much is pent up. And when you're pent up, there are people that are the haves that aren't releasing their wealth. They're not engaging that commerce that the have-nots would love to have. And there are these barriers, and I say it too much, but I'm not. I'll just say, let's just pretend that there is an interested barrier, and the rate of it is too high. And lowering that would allow this commerce to take place.
You think that's interest rates?
Well, maybe.
Okay, so one more piece of data on household formation, and that is related to immigration. We've been talking about this for a little while now. John Burns has done a lot of good research as well, and the the Harvard Joint Center for Housing Studies. A lot of acronyms to get my head wrapped around. So, Riordan Frost.
Right.
What is it?
Riordan? I think
Anyway, Riordan Frost, senior research analyst at the Joint Center for Housing Studies at Harvard, put out this interesting piece on what effects will the recent surge in immigration have on household growth, because we don't need to debate. There's been a major surge in immigration. The Congressional Budget Office estimated that 2.7 million people immigrated to the country in 2022, but then rising to 3.3 million in 2023, far outpacing the 900,000 person annual average that we saw in the 2010s. Again, take your politics out of it. We're talking about what that means. The people are here, and now what are we going to do about it, and how does it affect household formation?
First of all, it gives me a chance to say, track this. There's a lot of people coming in. Whatever you feel about it politically, if you want to track housing, it's important to track one of the major sources of population growth and of housing demand, and that's going to be and is immigrants. This article it wasn't as useful as I want it to be.
I know. So it more really kind of centered in on this, the headship. The head of household formation, and breaking down immigrants and what age groups and how likely are they to be the head of household. Which again is really it's like the precursor information to help us figure out where household formation is going, but then they never really kind of come to the conclusion on specific household formation
Yeah,
and how
yeah.
immigration is affecting it, other than it kind of gets through it in the first paragraph, is that there are 3x amount of non-native born folks that have or immigrant. There's about 2 million more immigrants that are coming to the country, at least in 23, than there have been in the past. Now, in 2024, that number has really slowed down. If you remember, the Biden administration took some executive action to close the border because it was becoming a major negative campaign issue. There's arguments and conspiracies that it was, a reaction from the Trump administration that was limiting immigration, especially during the pandemic. Opening things up, but also, we had a major labor shortage in this country, and we needed folks to do all the essential jobs that we need to keep running as a country, whether that's working in construction or working in food services, whatever it might be. And without that, we would have seen some more wage price spiraling, and this was the Biden administration's attempt at kind of monetary policy through executive action in reducing inflation by adding lower wage employees to the labor pool, and could it be contributing to this soft landing, although it's seen as a major political negative because it's like uncontrolled border crisis. You're not seeing who's coming in. It's unorganized. But the net effect is it's added folks in the United States. It's added employees into areas of the economy where we needed employees. And again, there are we've had a handful, 4 to 5 million more folks than we thought that we were going to have in this country. Again, that number is receding. We've got the Fred stats right here. You see a huge change, obviously, administration. We were getting out of COVID, but it's a pretty big declining to surging up there. And this is just the total populations relative to thousands of people. If you look at the percent change from a year ago, can we do a percent change on the fly? Percent change a year ago. Again, the number is down from where it was a year ago, but obviously we're much more elevated than we were during the pandemic. But that also started going down before the pandemic.
Yeah, I think that what frustrated me a little bit about this study from the Harvard Joint Center for Housing Studies is that it didn't have a conclusion about what can we expect for household formation? Is it going to go up? Is it going to go down? Their ultimate conclusion was a little bit like, well, actually, immigrant populations have a slightly lower.
They're basically saying we need more data.
Yeah, they're saying that we need more data, but I think they're also kind of chastening expectations that immigration will lead to a much greater proportion of or much greater household formation than a native born population. So they're saying that at any given age, and someone that's native born is going to be more likely to be a head of household, except for there's one group that is there's one age group that the numbers are the reverse, but as the native born grows, they're more likely to become a head of household, and they kind of outstrip immigrant population. And their reasoning is, it's pretty persuasive. There's a lack of networks or assets to help them maintain financial footing. There is networks can be one of it, but it's affordability. I think that here's their findings. Here is a good quote. If the age distribution and age-specific headship rates of immigrants are roughly similar to recent patterns, the estimated 6 million new immigrants could result in well over 1 million new households over the next 5 years. So that's a solid expectation there. 1 million new households over the next 5 years is pretty big. I think that, and if that is just from immigration, I think it's also it's not just like the people that are added every year as immigrants. It's like the existing immigrants peeling off from their existing household and forming a new household.
Yeah, exactly.
So these are implications that are, again, just worth following. If you're going to follow housing, you better track what the people being born, the new people, the old people, the young people, the new. Yeah.
And especially if you're in a state that, is closer to the border, you're going to see more immigration, but it's obviously folks who are moving all over the country as well.
Yeah. So household formation, Fed.
Buckle up.
I think that there's so much that is again, like pent up. This, I'm getting sick of saying that. I'm getting sick of saying the word interest rates. I would be released from all this pent up anxiety if we did have some progress here. I'm a little bit more hopeful this week, really, compared to last week with the GDP numbers. It's last year we said we're waiting for more pain. We're waiting for more pain. Do we have to feel any more pain before something happens, or
was the pain just the patience and the waiting?
Yeah. Because
there's been pain. There's been foreclosures. There's people in distress. There's people losing money. People aren't going to be, unless it's like a very public thing. Mm-hmm. Who's going to be making the big LinkedIn post of like, hey, this is all the money I lost.
Yeah.
This is the deal that I had to get back. Or this is the deal. This is the problem we're working through. It's
were
not like. Some people might, but
we were talking about like some potential video ideas yesterday, and the one that I had that I still think is like a good one is like what to expect when you're expecting a rate cut. What do what's going to happen first? What is it? Is it going to be that flurry of activity that we're talking about? If you're expecting a rate cut, do you get more aggressive before the rate cut actually happens? That's like, what is it? Beating the Fed?
From whose perspective? The
from
investors.
From an investor,
you usually want to flow with the Fed. Don't fight the Fed.
But it's fighting. Would it be fighting the Fed if you're expecting a rate cut and you try to get in before the market?
You just jump at the gun in the Fed.
Yeah.
But that's kind of comes back to the buy the rumor, sell the news. By the time the Fed's made the announcement or even signaled, a lot of that is going to be priced in or starting to be priced in. Fortunately, real estate moves slowly, so it's like there's going to be a lag, and it's different regions, different sellers, different situations. But yeah, once the word is out and the die is cast, then,
it's just so. I'm convincing myself here, but I've seen so much evidence of this barrier, right? Of home buyers, they're just reaching this point where they can't do anything. The sales activity for multifamily and for single family home sales is just sluggish, and there is this clear pent up demand. They didn't stop wanting to have homes, and same thing for renters. They didn't stop wanting to be renters. There is demand there, and it is building, and I wonder how much activity is going to be released if people have a more hopeful view of how much their dollar is going to be and how much money they can get going forward.
Well, the best way to kind of keep tracking that and finding out is to subscribe to the Gray Report on the Gray Capital YouTube channel, but also for the Gray Report newsletter, which you can sign up at grayreport.com or graycapitalllc.com/newsletter. And we'd love to send you an email every Thursday breaking down all these research reports and a lot more. I'm going to give a little Sunday update as well. And make sure that you like this video, assuming that you like it. I guess you can dislike it if you don't like it. And sometimes our most disliked videos are our most viewed. So that's okay. We usually get pretty positive. All right. Thank you for watching this edition of the Gray Report. We'll catch you next week.